Happy Wednesday out there, Team 42. It's your skipper here, Darius Delta, present our macro minute for Wednesday, September 3rd, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, will the global bond sell-off end our paradigm C bull market? Our answer, while it may over a short to medium term time horizon, we view that outcome as unlikely over a medium to long term time horizon because policy support is likely on the way. To start, the current global bond sell-off is much tamer than the sell-off experienced in late summer / early fall of 2022 and in the late summer / early fall of 2023, when yields were spiking higher according to the Bloomberg Global Bond Aggregate Total Return Index. The current level of 5.03% has breached the psychologically important level of 5% at a much tamer pace. Specifically, the current 20-day realized volatility of the index of 8.6% compares to a peak of 23.2% and 17.9% in the 2022 and 2023 global bond sell-offs, respectively. In addition to the reduced risk of forced deleveraging, major central banks around the world have ample scope to support their local bond markets after years of globally synchronized balance sheet contraction. Said simply, each of the world's major central banks have ample scope to accelerate asset purchases in the future, a de facto bailout in waiting for global asset holders. It's not a matter of if, but when. And the most important part of that equation, of the when equation, is whether the support comes before or after the next crash in risk assets. We think it comes before, but we can be wrong on that view. And if we're proven wrong, KISS and Dr. Mo will likely risk manage both sides of the next crash than the investors who think policy support comes after anyway. Heads we win, tails we win. That's the entire point of having our portfolios guided by institutional grade risk management overlays rather than our fundamental beliefs. If we're right on our fundamental views, then KISS and Dr. Mo will simply signal what we expect them to signal anyway. And if we're wrong on them, then they'll chop off the left tail of the distribution and tell me to go sit down. All told, money markets are currently pricing in little to no change in the policy rates of the PBOC, ECB, and Swiss National Bank over the next year, roughly two more 25 basis point rate hikes by the BOJ, and roughly two more 25 basis point rate cuts by the Bank of England. That essentially leaves the Fed to pick up the slack, which means it must deliver on the near 625 basis point rate cuts that are currently priced in over the next year to support global bond markets. As indicated in our recent research, we believe it will. Refer to our July 16th, July 22nd, August 4th, August 8th, August 13th, and August 26th leadoff morning notes, as well as our July 19th, August 2nd, August 9th, and August 23rd Around the Horn webcasts for more details. Transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This was not so much a question, but more of a comment. It's titled, The KISS Portfolio is Brilliant. It says, today is a perfect example of why the KISS portfolio is so effective. While both stocks and bonds are down, gold is up, showcasing the power of its modern asset allocation. By the way, this is from yesterday when bonds were down, stocks were down, and gold and Bitcoin were up big. Switching from the traditional 60-40 stock bond model to a 60-30-10 mix of stocks, gold, and Bitcoin is proven to be a brilliant strategy, especially when viewed through the lens of the forthturning macroeconomic dynamics. It's becoming clear that the rest of the market is waking up to a new reality. U.S. bonds are no longer the reliable safe haven they once were. So appreciate the comment. Thanks for the feedback to the client. And obviously, we wholeheartedly support the feedback. One of the most important things we've done in the sort of brief history of our firm, we're about half a decade old now. Or not quite a half decade, a little bit, about 4.5 years old now. And one of the most important things we did in the brief history of our firm is perform a econometric study on forthturning, macroeconomic policy and market dynamics. And that study became sort of a kind of a baseline understanding of, hey, how should we be expecting, the world to evolve? How should we be expecting economic and financial market risk to evolve over a long-term time horizon, given these preconditions? Obviously the precondition is the forthturning and everything that tends to happen from an economic policy and market standpoint in forturnings. And boy, it was that accurate. So we did that study back in the summer of 2023, and basically everything that's come true since then has really been born. Proven that study became sort of a perfect baseline for what has happened in financial markets and the economy since then. Now, that's not to say that every day, every week, every month, every year is going to, evolve in accordance to what, the baseline four turning dynamics are. That's why we have to do our jobs every day to make sure that we're moving along on track. But the reality is that that framework has proven to be both durable and incredibly lucrative in terms of helping investors stay on the right side of market risk with the right asset allocation mix. If you want to retire on time and comfortably in a four turning regime, of which there are probably 5 to 10 years left in this four turning regime, you need to make sure that you are not having a significant chunk of your portfolio exposed to the melting ice cube that is bonds. That's global bonds, treasury bonds in particular, which are at the epicenter of the geopolitical fraying that you tend to see in fourth turnings, which is why we continue to pound the table on the fact that there is a geopolitically driven supply and demand imbalance in the treasury bond market. And the Fed is the only institution in the world with a balance sheet that's large and flexible enough to fix that. And at some point, they will be fixing it. And at some point, the prices of stocks, gold, and Bitcoin will be much higher, certainly relative on a nominal basis, but also on a real basis and relative to the prices of the melting ice cube that is the treasury bond market that they're going to leave behind and continue. They've already left behind and are likely to continue leaving behind. So if your goal is to retire on time and comfortably, you need to make sure that you're exposed to the assets that are going to benefit from these dynamics, but also you need to make sure that you have proper institutional grade risk management overlays guiding your exposure to those things, because these are A, higher beta assets, and B, they generally have deeper drawdowns than bond prices do, than bond indices do. And so you need to make sure that, hey, if you're not going to get the defensive properties of allocating to bonds, because in our opinion they're no longer defensive, they are the risk asset in our opinion in the fourth turning. If you're no longer going to get the defensive property from asset allocating to bonds, then you need to add another element of defensiveness to your portfolio. And our element of defensiveness is our risk management overlays that infuse volatility targeting and dynamic position sizing into the KISS strategy. We're using the same models to run Dr. Mo as well, but Dr. Mo's with 70 different factors across, I want to say 12 different asset classes, as opposed to KISS, which is only 3 different asset classes. So wrap it up. Yeah, no, I obviously agree. The KISS portfolio is brilliant. Like I said, I use KISS to manage my entire liquid net worth. We'll be using KISS to manage my entire liquid net worth till I die. And then my wife and kids will use KISS to manage their entire liquid net worth. And then they're going to die. And then their kids, my grandkids, will use KISS to manage their entire liquid net worth, and so on and so forth, because I have to find a better mousetrap to keep retail investors specifically on the right side of market risk for a durable period of time, long enough to help them retire on time and comfortably. So super proud of the life raft we built, the financial life raft we built, and really grateful for the kind feedback we continue to receive from our clients who've been participating in the system and getting richer alongside me for the past few years. So we'll wrap it up there. Darius still here presenting our macro minute for is it Wednesday now? Wednesday, September 3rd, 2025. Best of luck out there today. We'll be here tomorrow. Tomorrow I'm going to be offline performing, creating our what the month is. Yeah, my brain's all wired. The September macro scouting report, which will be out Friday afternoon. So I'll be offline tomorrow, working on that. So catch back here on Friday morning. Cheers.